Most traders place stops where fear suggests. Professionals place them where control is revealed. The hidden sign is not price alone, but behavior after the test. Example: when price probes below support, volume dries up, spread narrows, and the rally returns effortlessly. Your stop belongs beneath the test, not the structure. That quiet rejection tells you who truly controls the movement, and it isn't the crowd. The placing of a stop is not a mechanical act, nor should it ever be dictated by hope, fear, or the arbitrary measurements of the public. Yet, this is precisely where the majority fail. The untrained trader places his stop where he feels pain would begin, just below a recent low, just beyond a round number, or at a distance that satisfies his discomfort. In doing so, he confesses ignorance of market control. The market is not moved by the public, it is guided by those with sufficient capital, information, and patience to conduct a campaign. These interests do not operate blindly, they test. A test is a deliberate probe of price into an area where supply is presumed to exist. Its purpose is not to break structure, but to discover whether opposing force remains. The professional places his stop only after such a test has revealed its answer. Consider what occurs during a legitimate test. Price may dip below a prior support, alarming the public and triggering their protective orders. Volume, however, tells the truth. If supply were present, effort would increase, spreads would widen, and price would continue downward. Instead, we often observe diminished volume, narrowing spread, and an immediate failure to follow through. This is not weakness. It is control. The composite operator has satisfied himself that selling pressure is exhausted. The correct stop placement, therefore, lies beyond the test, not beyond the emotional reference point. When a trader places his stop just below a visible low without regard to behavior, he places it exactly where the professional expects it to be. He is stopped not because his idea was wrong, but because his position was poorly aligned with the operator's campaign. One must understand that stops are not protection from loss. They are instruments of alignment. They must be positioned where the premise of the trade is invalidated. If a test has occurred and proven successful, meaning supply has failed to assert itself, then only a renewed expansion of volume and spread through that area would negate the position. Anything less is noise designed to unsettle the emotional participant. The market repeatedly teaches this lesson, yet few listen. They study price levels but ignore purpose. They observe movement but fail to interpret cause. The professional trader does neither. He waits for the test, reads the result, and places his stop where control would have to change hands for him to be wrong. In this manner, stops cease to be arbitrary losses and become evidence-based decisions. When aligned with tests rather than emotions, they no longer serve the operator, they serve the trader. And this distinction marks the dividing line between speculation and professional practice. The trained observer soon learns that price alone is an unreliable narrator. It speaks loudly, yet often falsely. Volume, however, when properly interpreted, reveals the presence or absence of professional activity. Of all the signs that distinguish control from confusion, none is more revealing than diminishing volume following a downward probe. When price is deliberately driven into a support area, the public assumes weakness. They see the break and conclude that lower prices must follow. The professional, on the other hand, asks a different question. Does supply respond? A probe is not intended to continue, it is intended to discover. It is a test of whether sellers still possess conviction. If genuine selling pressure exists, it cannot hide. Effort must expand, volume will increase, spreads will widen, and price will continue its downward path. The absence of these conditions is itself a powerful statement. When a probe occurs on reduced volume, the market is confessing that supply has already been absorbed. There is no urgency among sellers, there is no resistance to the advance that is being prepared. This diminishing volume is not accidental, it is the result of prior work. The composite operator has spent time and capital absorbing shares from weak holders. By the time the probe is conducted, little supply remains. The public, however, has no memory of this process. They react only to the present bar, and in doing so, they misinterpret quietness as danger. Observe carefully what follows such a probe. Price often hesitates briefly, then turns upward with ease. There is no struggle, no heavy effort required. This ease of movement is the clearest indication of control. The operator does not need force when opposition is absent. The rally that follows is not an act of aggression, it is a natural consequence of imbalance. The untrained trader frequently commits his most costly error at this moment. He interprets the probe as failure and exits, or worse, sells short just as the market is preparing to advance. His error lies not in his reading of price, but in his neglect of volume. He has watched the shadow on the wall and ignored the hand that casts it. Diminishing volume after a probe tells us that the market is no longer for sale. It tells us that any further decline would require renewed selling effort that is not forthcoming. This is why professionals are willing to take positions against apparent weakness when volume contracts. They are not acting on hope, they are acting on evidence. To trade successfully, one must train the eye to see effort in relation to result. A probe without volume is a question asked by the operator. A lack of response is the answer. When the answer is silence, control has already changed hands. Thus, diminishing volume after a probe is not a minor detail, it is a declaration. It announces that the path of least resistance is no longer downward. Those who recognize it align themselves with control. Those who ignore it remain at the mercy of appearances, and appearances in the market are deliberately deceptive. One of the most dependable principles in the study of market behavior is the relationship between effort and result. It is a law as immutable as gravity, yet it is persistently ignored by the untrained speculator. Effort is measured by volume, result is measured by price movement. When the two fall out of harmony, the market is revealing its true purpose. During periods of preparation, what I have termed accumulation, the market frequently displays heavy effort with little or no downward result. Large volume appears, prices fluctuate widely, yet no sustained decline follows. To the casual observer, this appears chaotic and dangerous. To the trained student, it is unmistakable evidence that weak hands are being eliminated and their stock transferred to stronger interests. Let us consider what occurs when selling effort increases, but price refuses to yield. Public traders, influenced by fear and recent declines, press their sales aggressively. They supply volume. If professional interests were absent, this effort would drive prices sharply lower. Instead, we observe absorption. The selling is met, not with collapse, but with support. Price hesitates, steadies, or declines only marginally. The result does not justify the effort. This phenomenon cannot occur by accident. It requires the presence of strong interests, willing to absorb supply without advertising their intentions. The composite operator does not chase price upward. He allows the public to bring stock to him. Every burst of effort that fails to produce result is another group of weak holders surrendering their position. It is precisely at this juncture that the emotional trader loses confidence. He sees volume as danger and volatility as risk. He fails to ask the essential question, what is the result of this effort? His fear persuades him to exit just as the transfer of ownership is nearing completion. Effort without result also serves a secondary purpose. It discourages participation. Repeated failures to decline convincingly exhaust the patience of sellers and confuse would-be buyers. This is not indecision, it is strategy. The operator requires time to complete his campaign. The appearance of futility is his greatest ally. Once the supply has been sufficiently absorbed, the character of the market changes abruptly. Effort decreases, and price begins to advance with ease. Where heavy volume once produced no progress, modest demand now produces meaningful movement. This reversal in the effort-result relationship is the market's confirmation that weak hands have been removed. The professional trader does not wait for news, indicators, or forecasts. He studies the struggle. When he sees effort failing to achieve its apparent objective, he recognizes absorption at work. His decisions are grounded not in prediction, but in observation. To understand effort without result is to understand the process by which markets are prepared for advance. It teaches patience, discipline, and respect for cause. Those who learn to read this sign cease to be victims of volatility. They recognize it for what it truly is, the sound of ownership changing hands, quietly and deliberately, from the weak to the strong. The public has always been inclined to believe that support is a line upon a chart, something fixed, visible, and permanent. They draw it with confidence, defend it with hope, and abandon it in despair when price passes through it. This misconception lies at the root of countless losses. Support is not a price level, it is a demonstration of control. It must be proven, not presumed. A level becomes support only when the market rejects lower prices. Until that rejection occurs, the level is merely a reference, an invitation to observe, not a signal to act. The composite operator does not respect lines, he respects conditions. He asks whether supply exists, and he answers that question through behavior. Observe what happens when price approaches a widely recognized support. Public traders place their stops just beneath it, believing they are protected. The professional sees opportunity. He may permit price to dip below the level not to continue downward, but to test whether selling pressure remains. This action, which alarms the public, is essential to the campaign. The true test of support occurs after the penetration. If price quickly returns above the level, spreads narrow, and volume diminishes, the market has spoken. Sellers have been invited and have failed to respond. This is rejection. It is not the holding of a line that matters, but the inability of price to remain below it. Many traders commit a grave error at this moment. They interpret the penetration as failure and exit precisely when the market is confirming strength. They have confused location with evidence. A level without rejection is hope. Rejection without continuation is fact. Rejection reveals the hand of professional interests. It indicates that supply has been absorbed and that further decline would require renewed effort. The ease with which price regains ground is especially telling. When resistance to the upward movement is absent, the path of least resistance has changed direction. It is important to note that rejection is not always dramatic. Often it is subtle, quiet bars, reduced volume, and a steady return toward value. These signs require patience and study. The public, conditioned to expect excitement, overlooks them. The professional waits for them. True support is thus a process, not a point. It is built through tests, probes, and failed attempts to go lower. Each rejection strengthens the foundation, not because the level is respected, but because the opposition has been exhausted. The trader who understands this principle places his trust not in drawings, but in demonstrations. He waits for the market to prove itself. When rejection is evident, his risk is defined, his stop is logical, and his position is aligned with control. In this way, support ceases to be a fragile line defended by hope. It becomes a verified condition earned through behavior and confirmed by rejection. Those who recognize this distinction no longer fear temporary breaks. They welcome them, for they know that true support is revealed not by where price pauses, but by where it refuses to stay. The student of the market must first rid himself of the illusion that intention is found in form alone. Charts are filled with structures, ranges, patterns, lines, and levels that the public studies with great devotion. Yet structure, by itself, is silent. It does not act, it only exists. Intention is revealed only through behavior, and behavior is always expressed in the relationship between price, volume, and time. The public assumes that because a structure resembles something seen before, it must produce the same result. They label a range as accumulation or distribution long before the market has declared itself. In doing so, they attempt to predict rather than observe. The professional never commits this error. He waits for the market to advertise its purpose through action. Behavior answers questions that structure cannot. When price approaches the upper boundary of a range, does demand expand or contract? Does effort increase? And if so, does it produce progress? When price reacts, is the decline labored or effortless? These are not matters of opinion, they are facts. They reveal whether strong interests are active or absent. Consider two identical trading ranges. One breaks upward with expanding volume, wide spreads, and immediate follow-through. The other edges higher on weak volume, stalls quickly, and collapses on the first reaction. Structurally, they appear the same. Behaviorally, they are opposites. One advertises strength, the other exposes distribution. Only the latter traps the public. The composite operator leaves footprints, but they are not found in geometry. They are found in how the market behaves under pressure. When supply appears, does price yield easily or resist? When demand enters, does price advance freely or struggle? These responses are the market's language. To ignore them is to trade blindly. The untrained trader often asks, "What pattern is this?" The trained trader asks, "What is happening now?" This distinction is critical. Structure suggests possibilities, behavior confirms probabilities. The professional acts only when confirmation appears. This principle is especially vital in stop placement and trade management. A stop placed solely on structure assumes intention. A stop placed on behavior respects reality. If behavior changes, if volume expands against the position, if result suddenly matches effort, the premise is invalidated. Until then, structure alone has no authority. Markets are designed to mislead those who seek certainty in form. Familiar shapes invite premature conclusions. Behavior, however, cannot be falsified for long. It reveals urgency, hesitation, absorption, and control. These qualities are beyond imitation. To read the market correctly, one must listen to what it does, not what it appears to be. Structure may catch the eye, but behavior reveals the hand behind the movement. When the trader learns to distinguish between the two, he ceases to be surprised by outcomes. He no longer asks why a perfect pattern failed. He understands that the market never promised anything through structure alone. Thus, the market advertises its intention plainly, but only to those trained to read behavior. All others see shapes and guess. The professional observes actions and knows. The placing of a stop is one of the clearest measures of whether a trader is thinking professionally or emotionally. The public places stops to relieve anxiety. The professional places them to define invalidation. This difference, though subtle in appearance, separates those who are repeatedly shaken out from those who remain aligned with control. The composite operator does not fear temporary adversity. He expects it. His campaigns are not smooth advances, but deliberate processes involving tests, reactions, and misleading movements. Any trader who places his stop where discomfort begins is certain to be removed, for discomfort is intentionally created. Fear is the tool by which stock is transferred from weak to strong hands. Public stops are predictable. They gather beneath obvious lows, below round numbers, and just outside visible ranges. These locations are not chosen for their logic, but for their emotional appeal. They promise safety through simplicity. In reality, they offer liquidity to the operator. When price is driven into these areas, it is not an accident, it is an operation. The professional, by contrast, asks a single question before placing his stop. What would have to occur for my premise to be wrong? If he has entered after a successful test, then only a renewed expansion of supply, evidenced by increased volume, wider spreads, and failure to recover, would invalidate his position. A minor penetration designed to frighten the public does not alter control and therefore does not justify exit. Aligning with the operator's risk means accepting temporary exposure in exchange for staying with the campaign. It means placing the stop beyond the point where professional interests would abandon their position. This location is rarely comfortable and never obvious. It is defined by behavior, not by fear. This does not imply recklessness. On the contrary, it demands greater precision. Because the stop is placed where control would truly change, position size must be adjusted accordingly. The professional controls risk not by tightening stops, but by sizing positions intelligently. The public does the opposite, trading too large with stops too close. When a trader aligns his stop with fear, he becomes reactive. Every fluctuation feels threatening. When he aligns his stop with behavior, he becomes objective. He waits for evidence, not emotion. This discipline allows him to remain in positions that would otherwise be surrendered prematurely. The market does not reward comfort. It rewards correct alignment. Those who place stops where the crowd feels safe will continually fund those who place them where logic demands. This transfer is not accidental. It is structural to the market's operation. Thus, correct stop placement is not merely a defensive act, it is a declaration of allegiance. One either aligns with the crowd's fear or with the operator's understanding of risk. There is no middle ground. Those who choose the latter may endure temporary uncertainty, but they gain staying power, and in the market, staying power is the foundation of consistent success. Trading is not a game of guesswork, nor is it won through hope, fear, or superficial observation. It is a discipline grounded in cause and effect, in the careful study of effort, result, and the intentions revealed by behavior. Every movement, every probe, every reaction is an advertisement of control, and those who can read it correctly gain an immense advantage over the emotional public. Stops are not merely tools of protection, they are instruments of alignment. They must be placed where the market proves your premise invalid, not where your nerves demand safety. Volume, effort, and reaction are the truest signals of professional control, and only by observing them can a trader distinguish noise from meaningful action. The trader who learns to see beyond structure, beyond price alone, and aligns himself with the intentions of the composite operator becomes patient, disciplined, and consistently profitable. Weak hands are removed, false signals are ignored, and real opportunity is seized. In the end, the market rewards judgment, observation, and alignment, not speculation. To trade like a professional is to place stops with understanding, enter positions with confirmation, and act only when behavior validates intention. This is the essence of mastery, seeing the market as it truly is, not as it appears to the fearful or the hopeful. Those who embrace this truth are no longer at the mercy of chance. They become participants in the flow of control itself.